Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Robinhood.
If you find our talks useful, please consider subscribe, like, and comment underneath. Also, we have a link in the description for a 14-day trial to StockOracle.
Right.
It's an affiliate link, so we do get a small commission if you sign up, which, helps support the show. But just a quick reminder, AI insights and value estimates can sometimes be wrong, so always verify the data yourself. We're here to focus on long-term wealth building, not short-term trading.
Absolutely. We want to look at durable growth and really figure out if a company can compound shareholder value over time.
Exactly. And usually when we talk about market valuation, there's this underlying expectation of precision, right? You expect it to look like engineering.
Yeah, totally.
A company sells 1 million units, the profit margin is 10%, and the financial analyst points at the spreadsheet and basically dictates the value.
It creates a sense of comfort, for sure. I mean, we like things to be categorized based on actual money-changing hands, measuring the historical performance to project the future.
Right.
But the moment you step into the arena of financial speculation, especially when it's heavily dependent on regulatory approvals, that conventional spreadsheet just shatters. We find ourselves looking at a valuation landscape that is incredibly murky.
It really is the absolute definition of diagnostic muddy waters, which is exactly what we're wading into today.
Yeah, it's a deep one.
Today, our mission is to unpack this massive sentiment shift and a frankly jarring market anomaly surrounding Robinhood. We're taking a huge stack of financial sources, SEC structured data, market metrics, insider trading reports, recent policy news, and putting them all under the microscope.
And we really need to separate the speculative hot air of a potential new regulatory environment from the hard, fundamental facts of the company's actual financial health.
Because the contrast between those two elements right now is, arguably the most fascinating dynamic in the retail brokerage sector.
Oh, without a doubt.
Let me set the scene with the catalyst for this whole conversation. So as of August 24, 2026, Robinhood stock closed at $103.62.
Which is a massive run.
Yeah, that is a jump of over 36% in just 13 weeks. But the trigger for this recent surge is the anomaly. The CEO publicly asked regulators to greenlight a market for tokenized stocks.
Just asked.
Right. That is all they did. They asked. And the market instantly rewarded the company by adding roughly $12 billion in market value.
It's wild.
Okay, let's unpack this because a $12 billion reward for merely asking a question to regulators seems completely irrational. As someone focused on capital protection, it's like valuing a local bakery at $1 billion just because they filed a zoning permit to build a drive-through, with zero guarantee the city will actually approve it.
It sounds crazy when you put it like that, but what's fascinating here is that the market isn't pricing in current quarterly earnings with that $12 billion. It is pricing in what we call regulatory optionality. The market is looking at a broader, highly supportive policy backdrop right now. You have the White House actively spotlighting prediction markets and hosting crypto summits.
Right, there's a lot of noise there.
And you have Congress pushing the Clarity Act, which is designed to create a stable framework for digital assets. Now, without taking political sides, and just to be clear for our listeners, we aren't endorsing these policies or the viewpoints in our sources. We are simply unpacking the arguments the sources are making about potential digital trading tailwinds.
Just looking at the mechanics.
Exactly. From a purely mechanical market perspective, a less restrictive regulatory environment acts as a massive potential catalyst for digital trading platforms.
So investors aren't buying the reality of the business today. They are buying the lottery ticket that Washington might actually build them a new highway to drive on.
Yeah, that's a good way to put it.
If the government creates a clear pathway for tokenized stocks, essentially taking traditional equities and trading them on a blockchain infrastructure, it unlocks a market that barely exists today.
It would be revolutionary.
But adding $12 billion in value based on an unapproved, highly speculative request means the stock price is completely decoupled from what the company did yesterday.
It is tethered almost entirely to what Washington might do tomorrow. And I agree with you, that level of speculative premium is dangerous if the underlying business isn't structurally sound.
Right. Because a $12 billion bump based purely on a request is highly speculative. We have to pivot. We have to look under the hood. We need to dive into the actual SEC financial data to see if there is a real concrete foundation underneath all this hype.
To see if they can survive if the regulators say no.
Exactly. If regulators simply say no, this company needs to be able to stand on its own 2 feet. We have to look at the wealth-building thesis here.
Well, when you look at the fundamental SEC data, the foundation is undergoing a massive evolution. The historical criticism of this platform was always that it was a single product, transaction-driven brokerage.
The meme stock days.
Right. It relied entirely on amateur retail investors making trades, rendering the company highly vulnerable to broader market cycles. When the market was hot, they printed money. When the market cooled off, revenue dried up completely.
Which is terrible for long-term compounding.
Exactly. But the filings reveal a totally different business model today. We can separate their growth into an existing engine and an emerging engine. They now have 13 distinct business lines, each generating over $100 million in annualized revenue.
13 distinct lines generating over $100 million each. That is a massive architectural shift from the company we saw going public.
It really is. We're talking about AI agentic trading, the Robinhood Legend platform targeting sophisticated active traders, prediction markets, expanded crypto offerings, private markets. I mean, it is a remarkably broad product shelf designed to capture every phase of an investor's life cycle.
Let's drill into the mechanics of why that matters. With AI agentic trading, for example, they aren't just giving people a button to buy a stock.
Right.
They're giving users the ability to set parameters so an AI agent executes trades automatically based on specific market conditions.
Which is huge for volume.
Yeah, that mechanism increases trade volume and user engagement without requiring the user to physically stare at their phone all day. And Robinhood Legend directly targets the high-net-worth active trader, competing with legacy platforms by offering advanced charting and analytics.
They're moving up market.
They are actively trying to graduate their user base from amateur meme stock traders to serious, high-volume participants.
And the hard numbers in the SEC filings validate that strategic shift. In the second quarter of 2026, they saw a record $1.31 billion in revenue.
Wow.
Which is up 32% year over year. But the most compelling metric here, especially for a wealth-building thesis, is the margin profile. They are reporting a 95.24% trailing gross margin.
That's almost hard to believe. 95%.
Yeah, and a 42.01% net margin. Alongside those record revenues, management actually cut their 2026 adjusted operating expense guidance.
Here's where it gets really interesting for me. Think about this structural shift, like a popular food truck that historically only sold tacos.
Okay, I like this.
The tacos represent their early reliance on simple stock trading. But they have successfully expanded that single truck into a massive, multi-level food hall featuring 13 different restaurants.
Right, the new business lines.
Exactly. With a 95% gross margin and a lowered operating expense ceiling, almost every new dollar generated by a customer buying a pizza or a burger instead of a taco falls straight into their pockets.
Yep.
They don't have to hire more security or build a new roof for the food hall every time a user tries a new product. The infrastructure is already built and paid for.
You have just outlined the mechanical power of operating leverage. When a company establishes a controlled, fixed cost base combined with exceptionally high gross margins, every incremental dollar of top-line revenue drops almost entirely down to the bottom line as profit.
Which is the holy grail for protecting and growing capital.
Exactly. That ability to cross-sell without requiring new infrastructure is the core of this super app thesis. If the platform can get a user who originally joined to buy public equities to also trade options, custody their crypto, and participate in prediction markets, they drastically increase the lifetime value of that specific customer.
And crucially, they do it without spending another dime on marketing to acquire them.
Furthermore, it inherently reduces the company's reliance on the volatility of a single asset class.
Right. They aren't just tied to the S&P 500 anymore.
Yeah. If the equities market goes sideways and trading volume drops, perhaps their prediction markets or crypto custody businesses are booming. The 13 different revenue streams create a diversified, durable financial engine that is much harder to disrupt.
The narrative so far sounds flawless. Revenue is at record highs, margins are hitting software company levels of perfection, and they're actively lowering their cost basis while expanding their product suite.
In financial analysis, perfection is almost always a mirage that conceals a deeper issue.
Always. When everything looks too good on the income statement, you have to look at the cash flow statement. And when we look at the SEC structured data for cash flow, it reveals a glaring contradiction that completely reframes the risk profile of this entire deep dive.
It is the glaring elephant in the room. Despite the record revenues, despite the 32% top-line growth, and despite the soaring profitability on paper, operating cash flow dropped dramatically.
Oh, dramatically.
Well, in the first half of 2025, operating cash flow was $4.15 billion. In the first half of 2026, it fell to $2.758 billion.
Ouch.
Yeah, that is a 33.6% decline. Isolating just the second quarter of 2026, operating cash flow looks to be hovering around only $0.72 billion.
Well, and I'm struggling to reconcile this. If they have 95% margins, record revenue, and over $13 billion in total cash sitting on the balance sheet, how on earth is their operating cash flow falling off a cliff?
It seems backwards, right?
It does. A decline that's severe suggests the earnings they are proudly reporting to Wall Street aren't actually translating into liquid cash in the bank. As someone who focuses on cash flow for valuation, that's a massive red flag.
This raises an important question about how we analyze financial institutions compared to traditional corporations. We have to account for the cash flow noise inherent to brokerages.
Noise, like accounting quirks.
Exactly. For a traditional manufacturing company, operating cash flow is straightforward. You sell a product, you collect the cash, your operating cash flow increases. But for a brokerage platform, massive customer cash movements heavily skew the operating cash flow statement.
Oh, because they're holding customer deposits.
Yes. Because they hold money on behalf of millions of users, normal user behavior like thousands of customers simultaneously deciding to move cash out of their accounts to buy a house, or reallocating cash into a non-cash asset flows directly through the brokerage's operating cash flow statement.
So because they operate as a custodian of other people's money, routine shifts in retail saving habits can make the cash flow statement look like a roller coaster, even if the underlying business of collecting fees and monetizing order flow is incredibly healthy.
It is a known accounting quirk of the industry. However, we cannot just dismiss a 33% multi-billion-dollar drop as mere noise.
Right. It's too big to ignore.
It is material negative evidence. It tells us that the reported on-paper profitability is not currently translating into stronger operating cash flow. It demands intense monitoring because if cash flow continues to deteriorate quarter after quarter while revenues allegedly rise, it points to a severe structural problem with how they are actually monetizing their user base.
That structural threat directly informs how we should interpret the current valuation, because the market has priced this stock as if execution will be flawless and regulatory approval is a guarantee.
The expectations are sky high.
The stock is currently trading at 43 times trailing earnings and over 18 times trailing sales. Investors are paying a massive premium for every single dollar of current profit.
And it carries a high beta of 2.35.
Yeah. With a beta that high, this stock isn't just going to feel a broader market downturn, it's going to aggressively amplify it.
It is hypersensitive to the broader risk appetite of the market. Any slight disappointment in earnings growth, any regulatory setback in Washington, or even just a macro-level market sell-off could trigger multiple compression.
And just to clarify for everyone, multiple compression is the scenario where the underlying business revenue stays exactly the same, but investors suddenly decide they are only willing to pay 20 times earnings instead of 43 times.
Right. The stock price crashes simply because the speculative premium evaporates.
That threat of multiple compression makes management's own behavior incredibly important to watch. If the valuation is that precarious, we have to look at whether the insiders are holding on for the long term or if they're quietly cashing out.
The insider trading signals in our source data present a really fascinating puzzle. Over a dense 3-week period in July and August 2026, company insiders executed 49 separate open market sales.
So 49 different times executives hit the sell button.
Yeah, but there are only 3 open market purchases.
A surface-level reading of that ratio suggests everyone internally is rushing for the exits.
It definitely looks bad at first glance.
But then you look at the actual volume of shares moved. Those 49 sales only amounted to about 562,000 shares total. Those 3 solitary purchases, they totaled 680,000 shares.
Wow.
Yeah, the volume of shares bought actually outnumbered the total shares sold.
It is the ultimate mixed signal. I mean, the sheer transaction count shows widespread distribution. You have a large number of executives taking chips off the table, which, often happens at these high valuations through pre-planned 10b5-1 selling programs to cover tax liabilities or diversify personal wealth.
Sure, that's pretty standard.
But the share volume tells a conflicting story. It indicates that a very small group of insiders has massive high-volume conviction in the future upside.
So how do we weigh those two realities together?
Weighing them together, the data leans neutral to slightly bearish. Widespread selling from dozens of individuals at a 43 multiple generally suggests the broader management team believes the stock is currently fully valued based on today's reality.
So we are looking at this incredible tension. We have a business model that is genuinely transforming into a highly diversified super app generating software-level margins.
The existing engine is strong.
Very strong. But that fundamental strength is counterbalanced by a terrifyingly high valuation, an alarming multi-billion-dollar drop in operating cash flow, and the stark reality that their biggest $12 billion catalyst regulatory approval for tokenized stocks could easily be met with a flat rejection from Washington.
It's huge risk.
Knowing all these severe risks, we have to evaluate what the ultimate payoff would be if everything actually goes right.
We have to map out the blue sky scenario.
Right. And to be clear, this is an optimistic scenario, not a prediction. But based on the sources, let's project out 2 to 5 years. What happens if the Clarity Act actually passes both chambers and cements a stable, permissive framework for digital assets?
Sure.
What if the current crypto expansion proves durable, keeping in mind that the data shows Bitcoin and Ethereum just had record weeks? And most importantly, what happens mechanically to this business if Washington actually greenlights 247 tokenized stocks?
If we connect this to the bigger picture, in that specific scenario, the company fundamentally evolves from a cyclical, transaction-driven retail brokerage into a diversified, continuous capital markets platform. The key word there is continuous.
As in, the market literally never closes.
That is the technological promise of tokenization. Traditional equity markets operate on antiquated infrastructure. They trade Monday through Friday, 9:30 a.m. to 4:00 p.m. Eastern Time, and they rely on centralized clearinghouses that take time to settle trades.
Which feels so slow compared to everything else today.
Exactly. The blockchain, however, operates 247, 365 days a year, utilizing smart contracts for instant atomic settlement. If traditional equities are tokenized, you could trade shares of a major tech company at 2 a.m. on a Saturday with the exact same liquidity and instant settlement you get trading crypto today.
The financial impact of capturing that market is staggering. You would be taking a secondary market that basically does not exist today. Weekend is overnight equity trading, and placing it directly onto a platform boasting 95% gross margins.
Yep.
They would generate new transaction, custody, and fee revenue around the clock with almost no incremental cost to keep the lights on.
The broader implication is a complete re-rating of how Wall Street values the stock. Currently, investors view their revenue as a series of cyclical spikes. It surges when retail investors are euphoric and plummets when they were fearful.
Right, which makes it a tough hold for long-term wealth building.
But in the blue sky scenario, powered by 13 business lines and a 247 global trading engine, that revenue transforms into durable, recurring income. Institutional investors will pay a much higher, more stable premium for a financial engine that never powers down.
So what does this all mean for the listener analyzing this stack of data today? Is the market currently pricing in the flawless execution of this 247 blue sky dream? Or is there still mathematical room for growth?
Yeah.
Because $12 billion in added value just for asking a question implies a dangerous amount of optimism is already baked in.
The optimism is heavy, but a comprehensive assessment of the data leads to an overall rating of 7 out of 10.
Which is moderately bullish.
Yes, which remains moderately bullish. The market is aggressively pricing in the optionality of regulatory approval, but it has not yet priced in the mathematical reality of a fully realized operational 24/7 tokenized market generating cash flow.
If the dream becomes reality, the current multiple might actually look cheap in hindsight.
The base case underlying that rating is actually quite strong. You have a significant Q2 earnings beat, a proactive reduction in expense guidance, and a highly supportive technical setup.
What are the technicals looking like?
The current price sits cleanly above the 20, 50, and 200-day moving averages, indicating strong positive momentum without flashing severe overbought signals on the longer timeframes. Crucially, even after this 36% surge, the stock is still trading 32% below its 52-week high. There is technical headroom for it to run.
But the cash flow contradiction and the 43 times valuation act as gravity.
They serve as massive risk bankers. The weight of evidence favors continued fundamental growth with meaningful upside optionality. But a sudden downturn in the crypto markets or a definitive regulatory rejection regarding tokenized stocks would hit a high beta stock trading at this multiple incredibly hard.
Bringing this all together, the picture is complex to clear. We are looking at a company that is successfully executing a massive transformation from a single-trick pony into a 13-lane financial super app, boasting margins that most corporate executives only dream about.
The business quality is undeniably improving.
But this is not a risk-free ride. The multi-billion-dollar cash flow contradiction is real and demands attention. The current valuation requires near-perfect execution from management just to tread water. And ultimately, the entire long-term thesis rests squarely on the shoulders of Washington regulators. It's a high-stakes waiting game to see if a regulatory option converts into actual durable earnings,
The fundamentals provide a temporary floor, but the government holds the keys to the ceiling.
which is the biggest threat here. Before we wrap up, just a quick reminder, if you want to dig deeper into these numbers, check out the link in the description for a 14-day trial to StockOracle. It is an affiliate link, so we get a small commission. And remember to always verify AI insights yourself.
Always do your own research.
Which leaves us with a final thought to mull over, building on the broader societal implications of this 247 tokenized market. If regulators do greenlight this structural change, and the stock market truly never sleeps, how does that fundamentally alter human behavior?
That's a deep question.
If you can trade traditional equities at 3 a.m. on a Sunday, experiencing the same instant dopamine hit of a crypto trade, are we truly democratizing finance and giving access to everyone, regardless of their shift work schedule?
Or are we just gamifying our sleep schedule?
Exactly. Turning global capital markets into an endless, always-on casino where the anxiety of portfolio management never actually pauses for the weekend. It's something to think about the next time you find yourself checking a stock ticker after hours.